Hello, everyone. My name is Eric Metz, and today I'm going to be giving you a brief overview of one of my favorite currency pairs in the Forex market, the New Zealand dollar against the Japanese yen. I'm going to go over some of the technicals and fundamentals and lay out a bullish case for this currency pair. Try and make the case for this currency pair going up, not only in the short term and medium term, but also perhaps the long term as well. So we're going to start with the technicals here. This is a weekly chart going back to the beginning of 2020, and it's gone from the bottom left to the top right. So basically, it's up. The trend is up for the better part of the past couple years. But if we zoom out more longer term, this currency has been more or less range bound for a very long time. If we go to this chart right here, going back a few decades here, and we've been floating under the 100 level in between 140 for the better part of 3 decades. So this market is range bound from a long term perspective. But the first thing I want to point out here is this trend line from the peak in '07 to the peak in 2014. We see this long term trend line right here that it has not tested. I'm not saying this trend line is a magical magnet, that the market is just destined to test it just because we found it. That's not how it works, but markets do tend to gravitate towards these long term technical phenomena. So I foresee this currency pair testing the 90 handle. The 90 handle also happens to coincide with this long term trend line. I foresee it testing that level before year's end. But we've got to break through this level first, this 86.70, 86.30 level, we'll call it, the mid 86 handle. These black these black horizontal lines are Fibonacci ratios, 0.786 fib ratios to be exact, from this high to this low and this high to this low. So they're long-term 0.786 fib ratios. And as you can see, as the market tends to treat fib ratios often, these fib ratios have been treated as significant resistance over the past 5 months or so. So we've got to break through that line, these fib ratios. And I foresee it doing something like this, or at least I want it to do something like this. We're going to break through it and then perhaps maybe come back, test it. Was what once was resistance, then becomes support, and then we're going to go up to the 90 handle. Doesn't have to do it exactly like that. It can do it at once. It's the market. I don't have any control over it, but I do foresee a breakout of some kind over the coming month or two, on up to the 90 handle. Now, looking more longer term, going back to this chart right here, I love these long term historical charts on investing.com. You can go back a long time. So, a lot of these charts go back to the beginning of this floating exchange rate system after the Bretton Woods system was broken apart. So, we go back to the early 70s here, and we started at 400 yen to one New Zealand dollar, made a high of about 435, and we went all the way down to under 100, on to 40 yen per New Zealand dollar. That is a huge move. I mean, that's like one of the biggest moves I've ever seen in the currency markets. It's just huge. So, technically speaking, I mean, here's your range. Here's the top of the range that it's been testing as resistance. We'll call it the 90 to 100 level. That is big time resistance, but if it can break through it and do something like this once again, break through it and then come back, test it, and then, I mean, it wouldn't be anything for this currency to go up to, call it, 120, 130, 140, 150. Wouldn't be anything from a historical perspective. So just keep that in mind longer term. So another big case for this currency going up is retail sentiment. If we go to retail sentiment here, how are retail traders treating this currency pair? And we can see that they are 26% short, 74%, or 26% long and 74% short. So the vast majority of retail traders are short this pair. If you know anything about retail traders, I mean, the majority of the time they're wrong. So you don't necessarily want to go with the retail crowd. They're trying to find a top, and that's something I just do not want to try and do, especially with these yen pairs. If you know anything about the yen over the past year, I mean, the yen has been sliding big time. It's one of the biggest moves I've ever seen in the currency markets. And it's been sliding against all the other major currencies. So I don't want to necessarily get in the way of that. So we're looking for a breakout on up to the 90 handle, and medium to long term, possibly way, way higher. Now let's get into the fundamentals. Let's start with the central banks And the policy divergence that exists in this particular pair, the most hawkish central bank in the world right now, at least in terms of the majors, the major currencies, is the RBNZ. The Reserve Bank of New Zealand has an end of year rate forecast of 3.8%. So that's the most hawkish central bank. Meanwhile, the most dovish central bank is the BOJ, and it's still at the zero lower bound, and they are still printing yen to keep Japanese government bonds at a certain level, pegged under a certain level. Yield curve control, which has been a huge part of why traders and market participants have been selling the yen over the past year. So the policy divergence is huge on this particular currency. We have the most hawkish currency, the New Zealand dollar, against the most dovish currency, the Japanese yen. So when you have massive policy divergence among central banks, those currency pairs trend. You can really find some great moves in those particular currencies. So you get yield with New Zealand, and that's another story. I mean, we're in an inflationary environment, and investors are searching for yield. They're searching for opportunities to make money and make a return, and that's something that not only investors do in low interest rate environments, but also inflationary environments like we're in today. And you get paid to hold this currency pair to the long side every single day. So I have a position on right now, and I got paid $10 on Friday to hold this currency. Obviously, the bigger your position is, the more you'll get paid, and vice versa. If you hold this pair to the short side, the more you'll get charged. So if you have a big position on, you'll get paid big. But if your position is small, your payout won't be that big. But the carry on this currency pair is large. It's very large and it's very attractive. So that's one um, big reason why this currency could trend higher over time. Investors are searching for yield. More fundamentally, if we get to the demographics of New Zealand, it's very similar to the U.S. The U.S. and New Zealand have relatively healthy population demographics, especially relative to other developed countries. So it's kind of like an hourglass demographic profile, and that bodes well for the economy and consumer demand, and basically the ability for the central bank to raise interest rates, and that gives investors that yield. Whereas Japan is a very negative, uh, unhealthy demographic profile, and we don't have a lot of consumers, not nearly as much in Japan's population. So therefore, you have much less consumer demand, much less consumer spending, much less investment, much less velocity of money, and that has a tendency to cause the central bank to keep interest rates low for longer periods of time, which they've done. In fact, they've gone negative, and it gives the government a strong incentive to spend more and deficit spend. So that means more yen sloshing around the system in order to create that demand and lack of growth. So it's a very interesting currency pair. I'm long, waiting on a breakout of this level on up to the 90 handle or higher, and we'll see what happens. Happy trading, friends.